Empire Earnings. Build your financial empire.
All right, let's talk about taxes. I know. Just hearing the word can make your eyes glaze over. But here's the thing. What if I told you the whole system is actually way less complicated than it seems? Today, we're going to tear it all down and look at how U.S. income tax really works in a way that actually makes sense for a normal human being. We've all heard this, right? Your buddy at work is all excited because, hey, free money. The government is sending them a check. It kind of feels like you won a little prize. But then, on the flip side, you hear this story. Someone else is totally stressed out because they have to get their checkbook and send money to the government. Definitely not as fun. So, what's the deal? How can two people in the same country end up with completely opposite results? Is it just random luck? A secret formula? Well, that's the big puzzle we are going to solve together right now. To crack this code, we have to start at square one. I mean, the very, very beginning. Before we even get into the numbers and the rules, let's just ask the most basic question. Why do we even pay taxes in the first place? Think about it. The roads you drive on, the schools in your town, hospitals, police officers, firefighters, all that stuff doesn't just appear out of nowhere, right? It all costs money to build and maintain, and the government needs a way to pay for it all. That's where taxes come into the picture. And that brings us to a super simple definition. Income tax is really just a piece of the money we all earn that the government collects to fund all those public services we share. It's kind of like everyone chipping into a big community pot to keep the whole country running. Okay, so we've got the why. Now let's get into the how, because this is where things get really interesting. In the US, income tax isn't just one single bill. Nope, it's actually a system with different layers. And this is our first huge clue to solving our puzzle. You see, there are potentially 3 different layers of income tax. You've got the big one, federal tax, which goes to Washington, D.C. Then you've got state tax, and this one is a big deal because it's different in every state. And believe it or not, some towns and cities even have their own local income tax on top of that. Let's make this crystal clear with an example. Imagine 2 people who make the exact same amount of money. Person A lives in Texas, a state with 0 state income tax. Boom. Person B lives in California, which does have a state income tax. Right off the bat, even with the same salary, they're having a totally different tax experience. And there it is, our first big takeaway. Where you live in the United States plays a huge role in how much you pay in taxes. It's one of the biggest reasons why 2 people can have such different outcomes at the end of the year. All right, lean in for this next part, because if you only remember one thing from this whole explainer, this is it. We're about to uncover the secret of taxable income. This is the concept that trips almost everyone up, so let's go through it step by step. Okay, so let's say you make $50,000 a year. It's totally natural to think, okay, the government is going to calculate my taxes based on that full $50K. I mean, it's what's on your paycheck, right? But think about it. Does that seem totally fair? The government knows you have to pay for rent, food, and, just live. So do they really tax you on every single dollar you bring in? The answer is a big, resounding no. And this right here is the aha moment for so many people. You do not pay tax on your total income. It's actually a pretty simple formula. You start with your total income. Then you get to subtract an amount that the government allows. That special subtraction is called a deduction. And what's left over, that is your taxable income. That's the only number the IRS actually cares about for calculating your tax. So let's run the numbers. You start with your $50,000 salary. Then let's say you take what's called the standard deduction, which might be around $13,000. You subtract that, and your taxable income is only $37,000. You see, you only pay tax on $37,000, not the full $50,000 that you earned. And I think we can all agree that makes a massive, massive difference in how much money you end up paying. Okay, so this immediately brings up the next logical question, right? If this deduction thing is so powerful, what is it and how does it even work? Well, you basically get 2 choices. The first path is to take the standard deduction. It's a simple fixed amount that the government sets every year. It's the easy route, and most people take it. Your other option is to itemize your deductions, which means you add up a list of your own specific eligible expenses. So why would you bother itemizing? Well, if you have a lot of specific costs, like big medical bills, interest on a home mortgage, or you gave a lot to charity, you can add all that up. If that total is bigger than the standard deduction, you choose to itemize because it lowers your taxable income even more. All right, let's just pause for a second and see how much we've uncovered. We now know why we have income tax in the first place. We know it's a multi-layered system that depends on where you live. And most importantly, we've cracked the code on taxable income, which is the real number that matters. We're so close to solving the whole puzzle. We have our taxable income number, but how does the government actually calculate the tax on it? And what are these things you always hear about called tax brackets? That, my friends, is the final piece of the puzzle.
Welcome to The Explainer. Today, we're going to tackle one of the biggest, most stubborn myths out there about taxes. It's one that might be costing you some peace of mind, maybe even holding you back from making more money.
You know the feeling, right? You get a pay raise. You're excited, but then this little nagging voice in the back of your head pipes up and goes, wait a minute, is this extra money going to push me into a higher tax bracket? Am I actually going to have a smaller paycheck now? It's a super common fear.
Okay, let me just put your mind at ease right now. The good news? That is completely 100% wrong. It's a total myth. And in the next couple of minutes, we're going to break down exactly how the system really works. That way, you can stop worrying and, start earning with confidence. All right, let's jump right in.
So, let's talk about the fear itself. Where does it even come from? Well, it's really rooted in just a simple misunderstanding of how tax brackets work. But it's a powerful misunderstanding. It can honestly make people think twice about going for that promotion or asking for a raise.
The secret to just blowing this myth out of the water? It all comes down to understanding one key idea. The U.S. has what's called a progressive tax system. If you can get your head around this one concept, everything else just clicks into place.
So what in the world does progressive even mean? Well, it's actually pretty simple. All it means is that as you earn more money, the tax rate you pay can go up. But, and this is the magic part, this is the bit everyone seems to get wrong, it's all about how that higher rate gets applied.
And here we go. This is it. If you remember one thing from this whole explainer, make it this. You are not taxed at one single rate on your entire income. The government doesn't just look at your total salary, slap a high percentage on it, and call it a day. Nope. Instead, your income gets broken up into different chunks or parts, and each part gets taxed at its own rate.
I like to think of it like climbing a set of stairs, right? The first few steps you take are at a really low tax rate. As you earn more and you climb up to the next step, yeah, you pay a slightly higher rate, but, and this is key, it's only on the income that lands you on that specific step. You don't suddenly have to go back and pay the higher rate for the entire staircase you already climbed. You just pay it on that new step.
Okay, so theory is one thing, but let's actually see the math in action. It'll make it so much clearer. We're going to walk through the numbers step by step, using a really simple model just to show you exactly how this whole thing works.
So, let's just imagine for a second. Let's say your total taxable income for the year is a nice round $50,000. So the big question is, how does the government actually tax that money?
Well, first things first. The system basically fills up the lowest tax bracket first, like a bucket. In our example here, that means the very first $10,000 you earn is taxed at the lowest rate, just 10%. So that's $1,000 in tax. Simple enough, right?
Okay, so now we move up to the next stair, or the next bracket. So the portion of your income from $10,001 all the way up to $40,000, well, that's a $30,000 chunk of money, right? That chunk gets taxed at the next rate up, which is 12%. See what happened? We didn't go back and change the rate on the first 10 grand. This second step just adds another $3,600 to your tax bill.
And finally, we get to the highest bracket your income actually touches. Now remember, you made $50,000. We've already dealt with the first $40,000, so that leaves a final $10,000. And it is only that last 10 grand that gets taxed at the 22% rate. So when you add up the tax from all the different buckets, the $1,000, the $3,600, the $2,200, your total tax bill comes out to $6,800.
Okay, so doing that little bit of math really shows you the huge difference between the tax bracket you're in and the tax rate you actually end up paying. And believe me, that difference is absolutely everything.
So here's the bottom line. Even though your income technically reached the 22% bracket, you did not, I repeat, did not pay 22% on your entire $50,000. Not even close. The vast majority of your money was taxed at those much, much lower rates of 10 and 12%.
And this just shows it perfectly. Your top tax bracket, what they call your marginal rate, was 22%. But your actual tax rate, that's the actual overall percentage of your income you paid in taxes, was only 13.6%. You just take your $6,800 tax bill and divide it by your $50,000 income. See? It's so much lower than you think.
All right, so now that we've seen how the math really works, let's circle all the way back to that original fear we talked about, and let's just bust this myth once and for all.
So the myth is that earning more can actually make you lose money. The reality? You will always take home more money after a raise. Always. It's only the extra money from that raise that gets taxed at the higher rate. Look, I'm going to say it again just so it really sinks in. There is absolutely no situation in the U.S. tax system where getting a pay raise will result in you taking home less money. Period. So, let's do a quick recap. What are the big things to remember? 1. The U.S. has a progressive tax system. 2. Your income is split into different buckets or brackets. 3. You only pay that higher tax rate on the chunk of money that's actually in that higher bracket. 4, and this is the big one, earning more will never mean you take home less money. And finally, 5, your effective tax rate, what you actually pay, is always lower than your top bracket.
So there you have it. Now you know how your tax bill is actually calculated, which is, a massive piece of the puzzle. But that does bring up the next big question, doesn't it? How and when do you actually pay all this tax during the year? Well, that's a whole other story for another day. For now, go get that raise.
All right, let's talk about something we've all felt. You land a new job, you're pumped about the salary, but then that first paycheck hits your bank account and it's less. Sometimes a lot less. So what's the deal? Where did the rest of your money go? That's the mystery we're cracking today. Okay, so let's start with a really basic question. We all know we have to pay income tax, right? But when does that actually happen? Do you just get a massive bill once a year and have to write this giant, painful check to the government? Or is there something else going on behind the scenes? And that feeling, right? That moment when you look at your salary offer, then you look at your actual paycheck, and you just kind of stare at it thinking, wait a second, where's the rest? It's a super common moment of confusion, and that's exactly what we're going to untangle right now. The answer is, it's happening all the time, automatically, with every single paycheck you get. You're not waiting for some big end-of-year tax day. The money is already being paid for you quietly in the background. And this whole automatic process, it has a name. It's called tax withholding. Yep, that's the official term for the money that gets deducted before you even get a chance to see it. So how does it work? Well, think of your employer as kind of like a tax middleman. For every paycheck, they do the math to figure out about how much tax you'll owe on that chunk of income, and then they send that money straight to the government for you. It's basically a pay-as-you-go plan for your taxes. And this whole thing introduces two really important ideas, gross pay and net pay. Your gross pay is the big number, the full salary you agreed to, say $4,000. But your net pay is what you actually get to keep, your take-home pay. In this example, maybe $3,000. That $1,000 gap? That's tax withholding. That's the mystery solved. Okay, so you might be thinking, why? Why do it this way? It seems a little complicated, right? Why not just let everybody save up their money and pay their own taxes once a year? Well, there's actually a pretty smart reason the system is set up like this. It really all comes down to two things: managing risk and making things convenient. Let's unpack that. For the government, it's all about risk. They get a steady flow of cash all year long, and they don't have to worry about millions of people just not paying at the end of the year. But for you, it's about convenience, and it's a huge deal, actually. It saves you from getting hit with a massive, soul-crushing tax bill in April. Can you imagine having to come up with like $10,000 all at once? Withholding spreads that pain out. All right, so we get why the money is taken out. But what is it exactly? It's not just one big income tax. Nope. That chunk of money disappearing from your paycheck is actually a mix of a few different kinds of taxes, each with its own job to do. For most people in the U.S., you're looking at four main players here: federal tax, state tax, Social Security, and Medicare. Let's do a quick breakdown of what each one of these covers. So you can picture it like this. That total deduction amount is a pie, and each of these different taxes is a slice of that pie. They all get cut out of your gross pay before the rest of the pie, your net pay, is handed over to you. So what do? Well, Federal tax, that's the big one. It pays for things like the military, national parks, stuff like that. State tax, and not every state has them, covers state-level services, like highways and schools. And then you've got Social Security and Medicare. You'll often see these two lumped together on your pay stub as FICA taxes. Now, these FICA taxes are special. They're basically for long-term public safety nets. Social Security pays for benefits for people who are retired now, and the whole idea is that when it's your turn to retire, the next generation's payments will support you. And Medicare is pretty similar. It's for healthcare for folks over 65. Okay, enough theory. Let's get practical. How does all this look in the real world? It's all right there on your pay stub. You just have to know what you're looking for. So here's the basic math you'll see. It starts with your gross pay, that big salary number. Then, line by line, it subtracts all those deductions we just talked about. And what's left at the bottom? That's your net pay. That's the cash that actually hits your bank account. And what's cool is, you do have some control over this through a form called a W-4, which tells your employer how much to withhold. And honestly, this is probably the biggest takeaway of the whole thing. When you're making a budget or planning your finances, your real income isn't your flashy salary. It's your net pay. Once you really get that difference between gross and net, you've taken a huge step toward really understanding your money. So just to wrap that up, taxes aren't a once-a-year headache. There's something you pay a little bit at a time, automatically, with every single paycheck you get. It's a system that handles multiple taxes all at once for you. But wait, that brings up a really good question, doesn't it? If we're already paying taxes all year long, then what is the point of filing your taxes in April? Why do we even do that? And yeah, what about tax refunds? If this is all happening automatically, how is it that some people get a big chunk of money back from the government? Where did that extra cash even come from? And then there's the other side of the coin. You know people who do their taxes and find out they still owe more money. How does that happen? It seems like the system should have gotten it right. Well, that's where tax filing comes in. It's like the final balancing of the books for the year. It's where you and the government figure out if you paid too much or not enough. And that whole process of settling up, well, that's a story for our next explainer. We'll see you then. All right, let's talk about something that drives a lot of us crazy every single year. Taxes. You know the feeling, right? You look at your paycheck, you see the money taken out, and then you still have to file them. It doesn't seem to make a lot of sense. So why do we have to do this? Let's decode it. I mean, it's right there in black and white on your pay stub, isn't it? A decent chunk of your hard-earned cash is gone, labeled taxes. You'd think, okay, I've paid up, we're good, but that's when the big question hits, right? Why do we have to file them all over again every year? If they're already taking the money, what's the whole point of this big annual chore? You see some friends getting a big check back and others having to pay more. Well, the whole secret starts with figuring out what filing really means. Okay, so the first thing to get your head around is this. Filing your taxes is really just a fancy way of saying you're sending a report to the government. That's it. Think of it like a year-end summary of your finances. And this report, it's officially called a tax return. And its whole job, its only job, is to figure out one thing. Did you pay the right amount of tax? It's not a bill, it's not a payment, it's just the final math problem. So what are you actually putting in this big report? Well, basically, you're telling the government three things. Here's how much money I actually made all year. Here's how much tax my boss already took out. And here are all the special deductions and credits that I get to claim. And that brings us right back to the big mystery, doesn't it? If your employer is already doing the deducting, why can't they just, get it right? Why do we need this final report at all? Well, here is the absolute key to the entire puzzle. The tax that's taken out of your paycheck, it's only an estimate. It's a really good guess, but it's not the final exact number. It's just an approximation. So why is it just a guess? Think about it. Your employer only knows one thing about your finances, how much they pay you. They have no idea about the rest of your life, right? They don't know about your big medical bills, or if you made or lost money on investments, or about the special tax credits you might get for, say, having kids or going to school. That's why your tax return comes in. You are the one who fills in all those missing pieces. It's your one chance each year to give the government the full picture, the complete story. And only then can they figure out what you exactly owed. All right, so you've sent in your report, you've given them the full picture, and now we get to the part everyone is waiting for. the big result. Did you pay too much or not enough? It can only go one of two ways. It's pretty straightforward, really. If the government's estimate was too high and you paid in more than you actually owed, well, they give you that extra money back. That's your tax refund. But if their estimate was too low and you paid less than you owed, you have to pay them the rest. And yep, that's a tax bill. Now, this is so important to understand. A tax refund feels amazing, right? Like you won a prize. But it's not a bonus from the government. It's literally just them giving you your own money back. You overpaid throughout the year, which means you basically gave the government an interest-free loan. It was your money all along.
Okay, let's look at a super simple example to see how this works.
So let's say over the whole year, your job withheld $8,000 in taxes. That's the estimate. But then you file your return, you add in all your deductions, and it turns out your actual tax bill was only $6,500. See the difference? You definitely overpaid. And that difference, that $1,500, that is exactly what the government sends back to you. That's your refund. It really is that simple. They're just squaring up the difference between the estimate and the final correct number. So how do you even fill out this final report? Well, you use a few key documents. The main one is the W-2 form you get from your job. It shows exactly how much you were paid and how much tax they already withheld. And if you did any freelance work or had other income, you'll get a 1099 form for that. These are basically the puzzle pieces for your tax return. Okay, I know that was a bunch of info, so let's do a super quick recap of the whole thing from start to finish. So, step 1, remember that the tax from your paycheck is just an estimate. Step 2, filing your tax return is you handing in the final report. Step 3, the end result is either a refund if you overpaid or a bill if you underpaid. And step 4, at the end of the day, this whole thing is just about settling up and making sure you paid the right amount for the year. And there you go. It's not some crazy, mysterious ritual after all. It's actually a pretty logical system for getting the numbers right. So now you really get the why behind filing your taxes. But knowing all this opens up a much more interesting question, doesn't it? If filing is just about settling up the final bill, how do savvy people legally lower that final bill in the first place? What are all those deductions and credits that can save you a ton of money? Well, that's a topic for another day. All right, let's just jump right in. We're going to talk about that thing we all wonder about, especially when tax season rolls around. How in the world do some people legally pay so little in taxes? And here's the secret. It's not really about shady loopholes. It's about understanding the system. And today, we're going to pull back the curtain on how it all works. Yeah, you've seen the headlines, right? Some big shot CEO pays less in taxes than their assistant. And you're sitting there thinking, how is that even possible? It sounds like it must be illegal, but what if it's not? What if it's just about knowing the rules of the game? So that's really the core question, isn't it? Is this some secret trick only for people with an army of accountants? Or is there an actual intentional system here that, anyone can understand? Let's find out. Okay, so the whole thing really starts with getting your head around two fundamental ideas, deductions and credits. They sound kind of similar, but trust me, the way they impact your final tax bill is worlds apart. This is the perfect way to think about it. A deduction is like a coupon at the grocery store. It lowers your total bill before the tax is calculated, so it shrinks the amount of your income that the government can actually tax in the first place. But a tax credit, a tax credit is like a gift card. It's a straight-up dollar-for-dollar reduction of the final tax you owe. It is way, way more powerful. All right, theory's one thing, but seeing the numbers makes it super clear. Let's make this real. Okay, so let's say after all the math is done, you figured out your total tax bill for the year comes out to $2,000. But hold on, you qualified for a tax credit. And remember what we said? This is a direct discount off that $2,000 bill, and this credit is worth $500. So, because it's a credit, the math is dead simple. Your $2,000 bill is instantly cut down by that $500. Your new bill is just $1,500. That is $500 that stays right in your pocket. See? This is exactly why credits are such a game changer. So you're probably wondering, okay, where do I find these magical things? Well, this isn't some secret club for the super rich. These credits are built right into the tax code to encourage things most of us do in our everyday lives. And you've probably heard of a lot of them. Got kids? There's the child tax credit. Paying for college? You might get the American Opportunity or Lifetime Learning credits. And for millions of working folks with low to moderate incomes, there's the incredibly powerful Earned Income Tax Credit, also known as the EITC. Now, here's where it gets really wild. Some of these credits, especially that EITC I just mentioned, they take this whole idea to another level. They're so powerful that you can actually get money back from the government, even if you owed $0 in taxes to begin with. How is that even possible? Well, that brings us to our next big concept, refundable credits. Yeah, you heard that right. This is the idea that a tax credit can do more than just erase your tax bill. It can actually put cash directly into your bank account. So it all boils down to this really important difference. A non-refundable credit is great. Don't get me wrong. It can knock your tax bill all the way down to zero. But then it stops. It hits a wall. A refundable credit, on the other hand, can go below zero. If your credit is worth more than the tax you owe, the government actually pays you the difference. Check out this table. It makes it crystal clear. So in both cases, let's say you owe $1,000 in taxes and you have a $1,500 credit. With the non-refundable credit on the left, your tax bill gets wiped out, which is awesome, but that extra $500 of the credit just disappears. Poof. But with the refundable credit on the right, it not only wipes out your bill, but the government literally cuts you a check for that leftover $500. You actually get paid. Okay, so when you start putting all these pieces together, you've got your deductions, your non-refundable credits, your refundable credits, you start to realize that handling your taxes isn't just something you do in April. It's really about a mindset shift. It's about being proactive all year long. And that is what we call tax planning. The key word on this slide is arranging. It's not about just reacting to a bill. It's the totally legal process of actively structuring your financial life to make the most of the rules the system already has in place. So what does that actually look like for a normal person? Well, it's things like making smart contributions to retirement accounts, like a 401k or an IRA. It's about keeping good records so you can claim every single deduction and credit you're entitled to. And yeah, sometimes it's about bigger moves, like deciding the best time to sell an investment to manage your income for the year. And I have to say this one more time because it's so important. This is not cheating. This is using the system exactly how it was built. The tax code is packed with these incentives because the government wants you to do these things. They want you to save for retirement or go to college or buy a house. These credits and deductions are the tools they use to encourage that behavior. So really, the biggest thing to take away from all this is simple. The tax system isn't just about paying up. It's about understanding the rules of the game. It's definitely complicated, but the more you understand how it's structured, the better you can legally and ethically navigate it. So now you get the basics of how it works for regular income. But that kind of leads to the next big question, right? How does this whole thing work at the very top? For the really wealthy, the conversation is less about their salary and all about investments and capital gains. How did those things open up a whole different level of tax planning? Well, that's a story for another time.
Have you ever looked at your paycheck, seen the chunk of money taken out for taxes, and then heard stories about the super rich paying a lower rate than you? It's a huge question, and in this explainer, we're going to pull back the curtain and look inside the tax code to see exactly how that happens. Okay, so for most of us, taxes are just a fact of life, right? It's this routine we go through every single year, almost on autopilot.
You know the drill. You get your paycheck, and before you even touch the money, a piece of it is already gone. That's the tax system. Pretty much all of us are familiar with.
But that's where things get kind of confusing. You hear these stories and you start to wonder, is the system fundamentally unfair, or are we all just missing a really big piece of the puzzle? Well, let's find out.
All right, let's dive into the first big idea. And honestly, this is the secret that changes everything. It's this: in the eyes of the tax code, not all money is created equal. Think of it like this. The tax code splits income into two main buckets. In one bucket, you've got earned income. That's the money you get from your job, your salary, your wages. And the other bucket is investment income. That's the money your money earns for you from things like stocks or real estate. And this single distinction is where the rulebook completely changes. And here it is. This is the core secret. The money made from investments, which, by the way, is how the wealthy make most of their money, is often taxed at a much lower rate than a regular salary. It's an absolute game changer.
I mean, just look at the difference on this chart. The tax rate on earned income can climb much, much higher than the rate on something called long-term capital gains, which is a key type of investment income. And get this isn't some secret loophole. It's written directly into the tax code for everyone to see.
So how exactly do investors get this sweet deal? Well, the answer lies in a specific type of profit called a capital gain.
So what in the world is a capital gain? It's actually really simple. It's just the profit you make when you sell an asset.
like a stock or a piece of property, for more than you originally paid for it. That difference, that profit, that's your capital gain.
Let me just walk you through a quick example. Say you buy a stock for $1,000. A few years go by, it does well, and you sell it for $2,000. That $1,000 profit is your capital gain. And here's the key. Because you held it for more than a year, it's considered long-term, and that's what qualifies it for that special lower tax rate.
Now, this special treatment isn't just for people who play the stock market. Business owners also have some incredibly powerful tools they can use to legally reduce the amount of tax they owe.
And probably the most powerful tool in their toolbox is the business expense. Basically, they can subtract the legitimate costs of running their company, from office rent to new equipment to marketing, directly from their revenue. And this all happens before their taxes are even calculated. The impact of this is just huge. Look at the table. If a business makes $100,000 in revenue, without deductions, they're taxed on that whole amount. But if they have $40,000 in legitimate expenses, the amount of income that's actually taxable plummets to just $60,000. That makes a massive difference to the final tax bill.
Okay, so we've looked at the two main pillars here, those special rates for investors and the powerful deductions for business owners. So let's put it all together and get to the real answer.
Which, of course, brings us right back to that original, burning question. After seeing all this, it's hard not to wonder, is the whole system just rigged?
Well, the real answer is a bit more nuanced. It's not so much that the system is secretly rigged, but that it's designed with very different rulebooks for different kinds of money. The system is set up to incentivize certain things, like long-term investing and creating businesses.
So to really sum it all up, the wealthy often pay a lower overall tax percentage for three main reasons. First, most of their income is from investments, which get those better tax rates. Second, they can use powerful deductions, like business expenses. And third, they treat taxes as a core part of their financial strategy, not just something that happens at the end of the year.
So what does all this mean for you? What's the big takeaway here? It isn't about finding tricks or loopholes. It's really about a fundamental shift in perspective. See, the tax system isn't just this thing that happens to you. It's a complex machine with rules and incentives. And once you start to understand those rules, you can start to approach your own finances in a much more strategic way. And that's really the bottom line. It isn't magic. It isn't some secret handshake that only the rich know about. It's simply what happens when you combine financial knowledge with a proactive strategy. And those are tools that are accessible to anyone who's willing to learn. So I'll leave you with this question to think about. Now that you understand the rules of the game a little bit better, what's one smarter financial decision you could make starting today?